So I'd like to introduce Joe Keys from Construction Labor Relations Association of Ontario. Joe?
Thank you, Sean, and good morning. It's my pleasure to introduce our first keynote speaker, Derek Burleton. Derek is the Vice President and Deputy Chief Economist for TD Bank Financial Group. He leads a team of economists that provides leading analysis on the Canadian economy and financial markets. You'll see or read him quoted in many media outlets such as the Globe and Mail, Financial Times, and The Economist. He has written many substantial reports on issues like healthcare, education, and immigration reform. TD's 2013 special report, Jobs in Canada, on Canadian jobs and skills shortage or mismatch, was widely read in our industry. Derek received his Bachelor of Commerce from Queen's University, so we do have representation from Kingston along with John Smith of the Bricklayers. Got to get that in. And he has a Master in Economics from the London School of Economics. Please join me in welcoming Derek.
Great. Thanks very much, and thanks for having me again. I was here a year ago. What I thought I'd do, as I did last year, kind of help set the groundwork for the day's events, and I've noted a lot of great speakers on the agenda. Carl Gomez is one who'll be covering the commercial office market, worked at TD Economics about 7 or 8 years ago, and he's a very, very strong economist. So too bad I can't stay around for his remarks, but I'm sure they'll be very enlightening. Just to whet your appetite on some of the things I want to cover, this is a little bit of the broad strokes, and I do want to bring it back for some of the broad implications to Ontario construction. A few things that I'm expecting. I'm expecting the year ahead to be a little bit better for growth. Not that it's time to pop the champagne corks. We're not looking at a boom. I think there are many areas of the economy here that are kind of in the mature phase, despite the recovery, and I do buy into the minister's comments on that. We are recovering, but it's a bit of an unusual situation in Ontario because some of the sectors have been going full blast now for a lot of years, and others have a lot of room to recover, like manufacturing. So, but anyway, I'll pull it together, and I think when you net it out, I think we're still looking at a bit of a jump up in terms of growth. Low inflation, that's been a big story. We're not expecting inflation to jump up in any notable degree. It's been very surprisingly low in Ontario and Canada. I think for last year, that was one of the big surprises of the year. The fact is, we didn't see inflation go higher despite very low interest rates. So, I mean, there's some factors behind that, and I will touch on it, but certainly that is a theme for the year ahead. Low interest rates, low cost of borrowing. This is key for interest-sensitive sectors of the economy. It's important for the Ontario government that rates remain low in the marketplace for borrowing. And that should very much be the picture in the year ahead, despite some upward drift. Canadian dollar lower. I think that's one of the reasons why I think we will get better growth in Ontario. I think the US dollar will get stronger in the world market this year. Canadian dollar will get weaker. And not everybody benefits from a low Canadian dollar. If you import a lot of goods, materials, inputs, you may find you're paying higher costs. But net, I do think it'll be better for Ontario. Commodity prices, very mixed picture. I'll present a few broad brush ideas there. And very lastly, in terms of equity markets, very important in creating wealth in the economy broadly, but also just in terms of company performance, capital market access. And I've got some few broad brush, conservatively optimistic comments on the equity markets towards the end. So anyway, I'll just kind of dig a bit deeper into all those themes. You know, in terms of the world this year, I think the one thing that I'm looking at is advanced world, the United States, Canada, Europe, Eurozone, looking better. I think a year ago when I spoke, I would have talked worries and the risks. Eurozone, still a lot of challenges there, but my worries have shifted a bit towards more of the emerging markets. I still think the emerging markets are going to grow, but certainly they're going to be a lot slower than they've been. But the good news is the advanced world is picking up, and I think for Canada and Ontario that's so reliant on the US, this is going to help us on a net basis, provided that the emerging markets, you know, conditions there don't unravel to create a big crisis, and I don't see it happening. I mean, we're looking, for example, at the Ukraine right now as being on the radar screen, and things appear to be dissipating a bit there, but it's still a worry. I mean, China, we're putting more focus on some of the emerging issues in China, which is key to commodity prices. You know, net, I do think, as I say, that with the advanced world picking up, I think we'll be okay here because the emerging markets are dependent on the advanced world as well. But I think the chart here shows you that I think if you look at the overall bar there, you've got economic growth picking up a little bit. That's the one takeaway in 14 and 15. The other thing is we're not going back to where we were in 2007 when you had a lot of borrowing happening worldwide. You had the subprime crisis in the United States. That was an unusual period that we are not likely to retest anytime soon. I think there are going to be ongoing legacies to that for quite some time. Split it up a little bit more, again, just to reinforce some of these themes. The emerging world is still growing faster than the advanced world. So the emerging world is now 50% of global economic activity. It wasn't that long ago, it was about 25%, go back 30, 40 years. And it's been growing in share with this rapid growth. Things are slowing there. We've seen now a number of years now that growth has cooled off. Some of it by design. I think when you grow too quickly, you run into problems. You grow too fast. Inflation. So governments have been leaning against that in the emerging world. And then you add on some of the challenges they've been experiencing. To give you an example, when the advanced world's running their printing presses, they're printing money to try and nurse their economies back to health. But some of that money tends to dribble into areas of the world that are growing faster, to a way of generating higher returns. But if too much money flows in, you lead to excesses. A lot of borrowing happens, and we've seen that in a number of emerging world, even China. So when all of a sudden central banks suggest they're not going to run printing presses as quickly like the U.S. central bank has done, some of that money is pulled out, and it's exposing some of these emerging market economies to the excesses, and this is the state we're in right now. The good news is, I mentioned the advanced world picking up will help mitigate that, but the other thing is the world doesn't look at all these emerging market countries in one basket. I think what we do know is that a lot of emerging market economies are healthy, others have more problems, and I think just given that distinction, it's going to mitigate the risk of an outright crisis among the emerging world, but it is something we need to watch. I think, as I say, I'm a little bit more worried about how the situation's unfolding, particularly the political situation in places like Ukraine, Venezuela, and that's very difficult to forecast. And if you're a forecaster, you don't tend to build that kind of unpredictability into your baseline. So all that to say that the growth is slowing and we expect it to flatten out at a lower rate. Advanced world will pick up a notch, and that's really important. That's 50% of the world, and it is accelerating, and I like the fact it's accelerating broadly. Eurozone will see growth for the first time in a long, long time in the year ahead. I think the United States is showing a bit more muscle, and this is going to be key to this region, and Canada will benefit, and so too will Ontario. Now again, speaking out of this side of my mouth, I would argue that it's not great growth. So the United States picking up to about 2.5%, 3%. They could be doing better. So there are reasons why they aren't, and it's still ongoing legacies of a very severe financial crisis 6, 7 years ago. United States, though, looking at steady, reasonable growth. If you look at the quarterly forecast, 2.5%, 3%. I think that's certainly better than we've seen on a trend basis in the past couple of years. One of the things this year that I like in the United States is the fact Washington appears to be getting out of the way a little bit. With the midterm elections coming up in the United States, I think there's a desire there that either major party wants to be seen getting in the way of a recovery, and they're backing off. So at the end of last year, we actually had the two parties reach sort of a budget deal, a 2-year fiscal framework, and that provides certainty to businesses. The deficit has come down a lot in the United States, which has been good, and at least they've got somewhat of a plan on how they want to take deficits down further a little bit over the medium term. And so I think that's good. I think the other thing they've done is they've raised their borrowing ceiling, which they've been kind of doing it on a 6-month increments. And what that does is if the private sector, for example, is not sure about where the government's going in terms of its borrowing capacity, they get worried and they delay investment. And so I think with the fact that some of these issues at least have been tidied up in the very near term, that's going to help the whole investment profile. The drag, we refer to it in economics land as the fiscal drag. It's both the indirect drag from uncertainty, but also the direct drag from higher taxes and lower spending to bring the deficit down is going to diminish quite a bit in the year ahead compared to last year. So I think that's good as well to generate more growth. U.S. employment's growing. The unemployment rate is interesting because it's been falling dramatically, but it's more to do, less with employment, more labor demand, and more to do with the fact a lot of Americans have been leaving the labor market, which isn't particularly good from a longer term perspective. You want your labor supply to grow because your employers are employing, public and private are employing out of that labor supply. So the United States still has some challenges, and I think one of them is to try and better understand what's going on here. How much of this is demographic? How much of this is just people losing, being discouraged after years of difficulty? And I think we're somewhere in the middle. Some of this, I think, will resolve itself, but there are some longer-term challenges, particularly the demographics, where the unemployment rate is falling as the economy recovers. Now, this chart's a little bit complicated, but I think the big takeaway from this is just simply, you've had a central bank in the United States, and this has been important from a global perspective, that's been printing a lot of money. It's unusual. Central banks don't tend to create a lot of printing press action because it can lead to problems in the economy. Inflation can go up. You can have too much excesses build. But they feel that the benefits in doing this outweigh some of these potential costs. A, there's no inflation, so that's not a worry. I think B, they feel the benefits are that you throw enough money at the system and some of it will get lent out and you'll get the economic recovery. So they've been doing it, and it seems to be going okay. We still worry about some of these longer-term challenges, but they're in the second phase where they're beginning to start winding it down. Not that interest rates are going to go up significantly, but they're probably, interest rates in the market will grind higher as the Fed slows down the printing presses, and that'll be a theme for the year ahead. You know, they're going to do it slowly because they're worried about the employment situation, they're worried about the recovery, and less worried about inflation. So I think it'll happen, and so far they're doing it without too much instability in the markets, despite some hiccups at the spring of last year. It's going okay. So that's a theme that the Federal Reserve is no longer accelerating the printing presses, creating money. They're beginning to slow down the printing presses a bit. And I think that's just looking at the next stage, that they can't continue to do this forever as the economy recovers. So it's important from a sustainability perspective. So what are some of the implications of a U.S. economy that's picking up a bit? Construction's picking up. Housing, you know, goes through a bit of ups and downs in the monthly data, but is picking up on a trend basis. Consumers are spending. That's all good. What are some of the implications of that? Well, one is that I think the U.S. dollar is going to go up in value this year. We call it the macho effect. I think when an economy grows faster than other economies, and it's going to grow faster than Europe and Japan, that creates attraction. Investors flock to those economies, much like they were flocking to emerging markets. That drives up the value of the U.S. dollar. So it means other currencies generally are going to fall against it. The euro and the yen we've got in the chart here. The Canadian dollar is going to be another one. We see it falling further on a trend basis, reaching as low as 85 US cents in the year ahead. So, you know, I look at it in a few ways. It used to be parity. It's 8.85. That's a big change in the relative value of the Canadian dollar. That creates an impulse. You know, it's a good thing for manufacturing, makes manufacturers a bit more competitive. It's good for the economy net-net. You know, we always say they're winners and losers. If you're an NHL team, it's a drag because you're paying salaries in U.S. dollars, so you're going to have to cough up more. We know from consumer perspective it's a negative because I think one of the things that economy's been benefiting from as the dollar's been strengthening is import prices have been lower. When you pay for U.S. dollar-made goods, machinery, consumer goods, you pay less for them, but when the dollar goes down, you're going to pay more. And over time, that's going to ripple through to a little bit more inflation than what we've had. And if you're a household, you don't want to see prices go up. Your wages, you know, hopefully will remain relatively steady and modest. And I think what we've been seeing some benefit from is the fact inflation's been below 1%. But that probably won't be sustained in this lower inflation environment. Winners are the resource sector, I think, net, because they sell their goods in U.S. dollars. So when they convert back, they're going to get more bang for the buck. But manufacturers, I think, are the bigger area. And I am of the mind that 85 to me is more of a reasonable level for the dollar, not parity was too high, I think. I think 65 is too low. I mean, there are balances with everything, because given the winners and losers. But I think 85 is more in the zone. So that's really our view, 85 to 90 over the next couple of years. So again, kind of bringing it back, I think some of the implications of this forecast are commodity prices are going to get pulled in two ways. And I know it's an important input into the construction sector, metals and some of the metal-driven prices. It's a net, because emerging markets are slowing on a trend basis. That's a drag, at least a net negative. But the stronger U.S. dollar as well, I think, is a net negative as well broadly. But if the Canadian dollar is going down, that's a positive, as mentioned. So I think when you net it all out, we're dealing with a fairly flat profile for commodity prices. Nothing exciting. I think the way I characterize the level of average prices is somewhere between the highs of the highs, which was back in 2007-08 was the peak, and the lows of recession. So we're in the middle, and I see on a trend, because you never get complete stability in commodity markets, a trend relatively stable. Again, it depends on which commodity you're looking at. There's a story for each market. And I would argue some of the metals will be at the top in terms of rising prices over the next 2 years, zinc and nickel, and some will be at the bottom. We got copper at the bottom. It just depends on the supply-demand balance within those various areas. Natural gas, we actually see some upside after a number of years in which that price has gone down a lot. It's bouncing back, and part of it's a winter story. A cold winter is good for natural gas prices. Oil pretty flat. Iron ore, we've got a bit of a decline there. Barley, some of the ag commodities will see declines because we've got a world that's fairly amply supplied with a lot of those crop commodities at the moment. In terms of bringing it a step closer to my ultimate goal, which is to provide some of the broad implications for construction in Ontario and the Ontario economy, the Canadian forecast is again this notion that you've got maturing sectors. The consumer is a little bit tapped, I think, broadly. I think the spending has been pretty dramatic. Debt has been growing. We've seen efforts by consumers to kind of pare back the rate at which it's been borrowing, which I think is a good thing overall. But it means you're not going to get the same growth in the consumer sector. You're not going to get governments contributing as much as they have. You know, infrastructure spending is still pretty strong, but after the stimulus surge, you're going to get some, and we're already seeing it show up in the numbers, a little bit of cooling. Obviously, you know, at the same time, we're all noting that there's being a bit of a shift as well in terms of what governments are spending their money on. But overall, governments, when you look at the restraint on the operating side, it's not as much of a plus. We know the federal government, their budget was actually showing a big drop in the deficit in the year ahead as they push for balance. And that's their goal, and they look like they're going to meet it. But it does imply a fair amount of money is going to get taken out of the system to get that deficit down, which is a near-term net drag. However, you know, I'm very even-handed economist, so I think we need to acknowledge that if a government improves its longer-term fiscal position, it's got more longer-term flexibility. If you're borrowing a lot in the near term, you're limiting your longer-term flexibility to move on key priorities. So it's very much a balance, and you want to also balance austerity versus growth. So it's a difficult line these days. But overall, those two sectors aren't. So where we see the improvement, as mentioned, is going to be exports and business investment. We expect those areas to at least pick up a notch, and that'll help at least keep the economy growing in Canada. Exports will improve, mentioning manufacturing quite a bit behind that. Oil production will continue to grow as well, and that'll help Canada and Ontario. Well, at least the manufacturing bit will help Ontario directly. Investment, I think, will pick up. We have talked a lot about, there's a lot of cash on corporate balance sheets in Canada. Leverage has been fairly moderate overall, unlike China, where the corporate leverage is just a lot of borrowing in the sector. I mention that because there's been a lot of focus in the media on that. But companies look to be in reasonably good shape. The profit performance for a number of quarters, at least the measures I look at, was quite weak for the first half of last year and heading into the year, but we've seen a bit of a rebound of late broadly, and I think part of that reflects manufacturing beginning to stabilize. So profits are picking up. I think that, you know, there's reason to think there's going to be a notch, particularly if some of the global headwinds, the U.S., subside a bit. I think that will help investment. We're not looking at a huge surge in investment, and I think some of the data coming out of the capital intention plans of companies and the government reinforce that, you know, yes, a bit of a pickup, but nothing great shakes. But certainly I think exports, if they improve, a lot of the big investors in this economy are of an export nature, and those two tend to come hand in hand. Household is mentioned. I won't talk a lot about the household debt. I think what this chart shows you, the gold line shows that the rate of growth in household debt borrowing has been slowing now for a better part of a year and a half, and this is a necessary adjustment, and I still worry about a vulnerability there. You could apply this to housing as well, and I'll touch on that in just a second, that if it's okay, I think, on its own, if Ontario grows as we expect, which is moderately, interest rates remain low. I'll touch on that in just a second. Households should be okay. What you don't want to see is any kind of big financial crisis globally, because if the world looks much bleaker, then that will come back to hurt households, it'll come back to hurt businesses in this economy. And that's kind of hypothetical, but that still very much is in play, because if the debt levels are high, households don't have a lot of wiggle room as much as they did sort of 5, 6, 7 years ago, despite the recent slowdown in the rate of borrowing. Inflation will grind higher. It's still going to be low, below 2% until kind of the tail end of next year. That's a pretty low rate of inflation, and that gives the central bank more room to keep interest rates very low. We're expecting short-term rates to remain glued pretty much at 1%, not as low as in the United States, but pretty low. And a central bank, we'll hear from them in a few minutes, actually. I don't wear a watch. I don't know why I'm looking at my hand, but all that to say that it's coming up. They make their announcement, in fact, probably about now, and I don't think they'll change their interest rate. There's no reason to. Inflation's still pretty low, and they do want to ensure that the economy continues to, certain sectors continue to recover. So we don't see any change there until the tail end of next year. So very stable and steady, but be prepared for a little bit of an upward grind in some of the bond yields. Market rates will grind higher as some of these expectations of an improving U.S. economy bring up U.S. yields, and same too in Canada. So we've got 10-year bond yields rising a bit. So I think the point there is rates are going to remain low, but for some longer-term borrowing terms, you're going to see a bit of an upward grind in some of the rates in the market. And this is actually a healthy thing. I think it's in line with a recovering economy, even though only gradual. So I'm just going to finish off, and hopefully there'll be a few questions out there, with some of the implications for Ontario and the construction sector. I think very much everything I've said about Canada applies to Ontario. I think Ontario had a pretty disappointing year for growth in 2013. And we're looking at a bit of a step up in 14 and 15, but getting back up to kind of 2.5% on average, which is okay. It's not great, it's okay. And I think one of the themes we're seeing, and I apologize for some of these charts and a lot of bars, but I think one of the broad themes from a regional perspective is that some of the advantage out west is going to erode a bit. And we're seeing some signs in Saskatchewan, and some of the big economic drivers of late, at least the growth drivers, are beginning to subside a bit. Alberta's cooling off a bit. Saskatchewan's cooling off a bit. BC is not doing as well as those economies, likely to pick up a bit. But Ontario, with manufacturing, I think at least resuming growth, and it's not going to be great. It's still going to leave us at a fairly low level. But in terms of the growth impact, it's going to lead Ontario more to the middle of the pack, and I think we're going to see some convergence in regional growth over the next 2 years, which I think is a good thing. I think more balanced growth across Canada would be good. So Ontario, again, applies. It will see a bit of an improvement going forward. In the U.S., just the linkage of Ontario and the U.S. is the key reason why. Just a quick comment on housing. Housing has been an extremely important driver of growth in Ontario in recent years. We probably overshot in terms of price growth, and prices have really picked up of late. So you get volatility in measures of prices. But what I will say is that we're dealing with probably a sector that is in need of a bit of a tapering off, and we're seeing it show up in some of the new construction activity. And I think this is a needed adjustment, much like government has to deal with its deficit. You just can't allow deficits forever. It's got to bring it down over time. Construction and housing just can't go up forever and ever. It's a cyclical industry, and I think we're beginning to see signs of tapering more in the new home market, rather than the broad Ontario resale market. But even there, resales have flattened out. I know that we go through ups and downs, but they're not at record levels at the moment. Prices have really picked up. What I think will be the theme there will be, with a lot of supply coming on the market, a lot of condos, particularly in some of the key urban regions of the province, that additional supply will bring down price growth. And we're not looking at any major adjustment here in the next 2 years, partly because rates will be low. Economy will grow. I come back to the vulnerability. If things get really messy in the world, then that would be a different story, but we don't have that in our baseline. So all that to say that prices will remain what we call overvalued. So, and this is a bit of an esoteric kind of concept, but all that to say that, based on our measures of the economy, prices are probably about 10% too high. But you can have that measure of overvaluation go on for a long period of time. So that's where we're sticking to that concept. We're about to put out a report that talks about GTA region. I know a lot of you are from within the GTA, also outside of it. And one of the interesting things there is that we paint GTA market with one brush, but it's just the dichotomies across the whole sector so visible. You know, you see downtown condo market has probably got more room to adjust, more supply. The single attached market in the 905 is still very tight. So that's one. Within the condo market, you got low rise versus high rise. You've got, so the report, really the theme there is you cannot just say GTA market growing by this or shrinking by this. It's very much it depends on the segment. But overall, the broad stroke is that you're looking at relative stability, I think, in line with sort of the fundamentals there. New home market, I think, in Ontario generally will cool down. That's our view on home starts. Just a few comments on some of the other areas of non-res. And, you know, some of the themes there have been, this just shows you a picture of building permits in 2013. And I think what we have seen is a bit of a, you know, it's becoming a bit of a mature industry in that despite the recovery, it's been a market that's done extremely well. Commercial construction's been very robust. Institutional engineering been very robust. The industrial has been an area that's had more trouble, and there's a bit of upside there as manufacturing does pick up a bit. We're seeing a lot of manufacturing industries that have very tight capacity use. So the hope is that some of this will flow through to more investment in plant, and the lower dollar helps that. Within the other two areas, I think commercial is one where decent momentum, and we'll hear a lot more about that today, heading out of last year into this year. But I think the rates of growth are cooling, and same thing with the government side of it, that after the stimulus period, we're getting some maturation. Still good numbers, but not the growth is going to subside. Within the commercial, you know, and this shows you vacancy rates, you're beginning to see a bit of an upward tick in the vacancy. This is just GTA, by the way. You know, and I think the view is you've got a lot of new inventory coming on the office market in this region in particular, and I think we're likely to see an upward tick in the vacancy rate going forward. So, you know, again, still a fairly healthy market, but, you know, just the sheer amount of projects underway are going to change that balance a bit going forward. So it ties in with our view of a bit of a cooling in the addition of construction to the Ontario outlook. And the office, the industrial vacancies, as mentioned, maybe a bit more upside on that front. Government deficit, I kind of talked on a bit. You know, much like the federal, you've got a deficit that's been coming down in Ontario, and the signal we're getting is that the government is going to stick with its plan over the medium term to erase the deficit. You know, the debt is, to me, a concern, and I know that we need to balance all those things I talked about. You need to balance, and I buy into the minister's comments 100%. We need better transportation infrastructure in this region, you know, and other urban regions of the economy. What you don't want is if you take on too much debt, it can be destabilizing from a long-term perspective, and we've seen a lot of debt be taken on. The debt to GDP, this is another very difficult chart to read, but the debt to GDP is about twice its level of sort of 15 years ago, and it's more the direction that I think we need to see taper off, and it's going to mean more selection. Infrastructure, yes, but we need to be more choosy in what we finance, but we're seeing that happen already. Government has been doing a lot in education. That's shifting. Health, it's shifting. Transportation. And I do see we've been very vocal in our support for transportation infrastructure, even open to the idea of levying introducing some new revenue sources to pay for it, because we acknowledge you got to pay for it somehow. As much as some of our TD clients don't like the utterance of higher taxes, but I think we need to be realistic about where we're going here and understand it's such an important element to the long-term strength of this economy, which I think overall still remains reasonably good with some of the positive demographics and the like. Just again, I won't go through a lot of this detail. I think the point being is that even within the various sectors, a real balance. Some of the areas of strength we're going to see. Construction, yes, we're seeing higher intentions in the year ahead, albeit nothing great. It was pretty modest in terms of the recent survey results put out by StatCan. Overall construction intentions, investment in Ontario. Machinery and equipment, by the way, has seen a real surge, and you could argue this is good from a longer-term productivity perspective, that companies look like they're more willing to invest in productivity-enhancing equipment and machines. So we like that aspect of the recent report. Public versus private, interesting, the public's intention surged, but it's less non-residential, more capital equipment and that kind of thing. So governments look like they're focusing as well on reinvesting in certain areas. Again, Infrastructure, government still at a healthy level, but slowing down a bit. And across the sectors, some of the areas of strength, transportation is an area where we're seeing growth. And finance, insurance, real estate, and management sectors, some looking at a bit of a pullback. Manufacturing, surprisingly, but those could be revised upward as we go through the year. You often get that happen. These are early signals. With the lower dollar, you might convince some manufacturers to invest if we're right in our view on output growth. And some of the government areas look like they're going to cool off, as mentioned. Very lastly, just a bit of a broad stroke on the equity market. Again, it's an important element. Capital markets are important to sort of ensuring that companies can borrow and invest. And overall, it's also important to certain areas of household wealth, along with housing. Housing's even a bigger driver, as we know, and I've given you the view there. But the story in the equity markets has been very much one where the U.S. is just, a lot of money's been moving into the U.S., and their equity markets have been on fire. Canada less so. Equities have been going up, but at a much slower rate. So far this year, Canada is ahead of the U.S., so I think we're beginning to see a bit of a rotation there, which is good from a Canadian perspective. And that'll be, I think, a theme this year. Maybe the U.S. still doing okay, but you're going to see the Canadian equity performance converge a bit. And I think, again, tied to the fact both economies are growing, but Canada is still having a lot of relative strength. Some of the resource sector has been hammered, and I would imagine we get a bit of an uptick there after the drubbing last year, so in mining overall. So very broad. So this is, again, coming back to some of the themes in the outlook. I think we're expecting the global economy to pick up a step. The risks are shifting away from the advanced to the emerging market. We'll keep our eyes on countries like Ukraine and Argentina and China, as we always do, but I think we'll be okay. We'll get through it. Ontario's economy should benefit from an improving global environment. Lower dollar will help to drive more exports and more business investment. And some of the areas that have been real stalwarts, if I can use that word, of the expansion in recent years are still going to do okay, but I think their contribution is going to mature a bit, and construction is within that fold. And just from a medium-term perspective, we got the upcoming Ontario budget, and we'll unlikely see any major shift in the plan there. We'll wait and see. This does remain a risk, and I underscore that I do watch the debt. I feel I'm very balanced in my view on government finances. I'm not a debt hawk by any stretch, but I recognize unsustainable trends, and unsustainable trends are like this, and so that there needs to be focus on thinking of the long term as well. So, and within the broad plan, there are elements of that happening. Operating deficits coming down. Hopefully, that'll continue to happen. So, anyway, that is kind of the world from my perspective in a nutshell. And so, Sean, can I pass it back to you?
Sure.
Yeah. Thank you.
Please, round of applause.
Thank you. Thank you.
Thanks very much, Derek, for, as always, a very comprehensive overview of global economic conditions and also what's happening here in Ontario. Really appreciate you linking it to construction opportunities going forward. Are there any questions from the audience? Okay, Mike?
Hey, Sean, thanks. Derek, thank you. Yeah, just in your wrap-up, you noted a couple of comments there. One was commercial spending has likely peaked in this cycle. So that gives me a little bit of concern, because I think most of our work has come from the public sector spending, and we're kind of waiting for the commercial side to really come to the table, although there's been some good lights. So just with regard to that, I had a little question here, and what is your thoughts and comments with regard to Chrysler's comments yesterday in the news around their Brampton and their Windsor plants?
Right.
What do you think the impact of that is?
Yeah, again, just to reinforce, I think we would have a little bit of growth in the non-residential construction. I think what I'm saying is that the growth, I think, has peaked. It's been a good run based on the numbers I'm looking at. I mean, the amount of office construction, a lot of the housing boom as well has fed into the commercial market, because you're getting a lot of the plazas being tied to a lot of these high-rise projects. So I think we just feel, and it's consistent with the intentions, that you're going to get a bit of a slowdown in the contributions. So, and I'm not saying it's hard to predict the timing. It's very broad brush that after the big long run, if we're not at a peak, we're close to it. And but again, shifts within that, industrial, a bit more upside. Government, we just had such a wave of projects. So I think we're going to still see a lot of spending, but it's going to be, we're going to see a bit of a shift in terms of where the spending happens, which I think is a good thing, because certain areas have been more hungry and starved for funding than others, transportation being one. And on the Chrysler comments, it was interesting. Yeah, those took me by surprise yesterday. It was in the paper today that the Chrysler had applied to the federal and Ontario governments because really within the auto sector, it's been very much par for the course. And when one of the big three in particular, and Toyota and some of the Japanese transplants, when they make a big investment announcement, they look to governments for support. This has been in the playing field now because a lot of the U.S. states in the South have been providing huge subsidies to locate facilities, and it's been on for a number of years. In Mexico, they don't have to as much because they got the really low labor costs. We've seen the investment shift to the South, the U.S. and Mexico in recent years, and it's concerning, no doubt. I don't quite know how to take it because I think when the head of Chrysler spoke yesterday, he said they're withdrawing their $700 million application for the subsidy to invest in some of their big plants here. They're going to continue with some of the near-term investment. They don't say how much. They give some broad strokes. They're going to continue to push ahead with some of their plans, but we don't really understand. They refer to this being used as a political football between the governments. So like you, and you're probably the same with me, I kind of read it thinking, I don't really fully understand what's happened here in terms of why, you know, and how much of this was Chrysler's decision, how much was it maybe the governments couldn't reach agreement, or whether they, you know, Chrysler balked at setting employment term. So I think we have to wait for more details on that. I think you can take some good news is that they didn't say that they're pulling out all their investment because they didn't get government support. They're still planning on moving ahead with some of their plans to invest in Brampton and Windsor, and I think that's good. But they're putting a lot of the stress now on the union negotiations in 2016 and saying if we don't get a better deal, then there's a risk of a real pullout. So it's very much an evolving thing, but it's a great question. I don't know precisely what happened in those negotiations, but so there's some good news, but some concern.
I just hope Chrysler's changing their tactic on how to seek and obtain federal and provincial monies rather than being so public about it, maybe being a little bit more private about it.
Yeah, that's a great point, Sean. Yeah.
Okay, great. Just a reminder, if you have written questions, Stu and Rishi, where's Rishi? At the back there, just raise your question and submit them. All right, Russ.
Yeah, Ross Tias out of Sarnia. Derek, you talk a little quicker than I can hear, but
it's a lot to cover.
No, you're
lots to cover.
That's not because you're from Sarnia, Russ.
No, it's not the water. But no, you're very insightful, and we can listen to you all day.
I appreciate it.
Last year's conference did mention, and I think the theme was the Ring of Fire.
Yeah.
You never mentioned a thing about that, or the potential that we just have to us with TransCanada talking about the Energy East. Could you maybe make a comment on those two issues and the eventual effect to Ontario, or is this long-term and is that pie in the sky?
Yeah, no, you're right. And no matter how much I cover, I'm going to miss a number of things. And the Ring of Fire is something we were hoping to do a big research project on it to see, because this is this enormous resource potential in the north, which would deliver a lot of benefits to the northern communities. So Ontario does have a resource sector as well, but a lot of this would be the potential for the future. And I think we haven't done anything on it yet because it just seems to get pushed back further into the future in terms of some of its potential. Not that all activities have dried up, but there have been some challenges. Low metal prices haven't helped in recent years, and some of the challenges there. You know, it's one of these things that I'm hoping we'll see at the light of day, but it is a long-term thing that we're looking at, unfortunately. And it's the same with Quebec. Quebec has the same kind of potential for its north. But they may be moving fairly boldly on certain elements of it, but it just continues to get pushed back. Many of the elements of their Plan du Nord, or it's got a new name for it now. But so I would say it's something we're going to focus, and if there's some momentum there, I will jump on right about it, because I think it's something that I think, there's just so much potential, but I won't just do it now because I think it'll fall on deaf ears, and there's just a lot of near-term uncertainties that would kind of dull the benefit of the reports. So. Ring of Fire, I think the same thing with the pipeline issue, that just a lot of, this is more longer term. These things aren't moving very quickly. There's more talk now about, the West sending more of its energy east to Eastern Canada through Ontario. But you know, I just know the processes of this. They tend to move very slowly, albeit it seems like there's probably a bit more likelihood that that will go ahead than, say, you know, the Asian Gateway in BC, which is just completely gummed up with a lot of issues, long-term issues. So it's very important. I must say, just the resilience of the oil sands to getting their product to market continues to be shown to me. We saw the announcement today that Enbridge is going to invest $7 billion in its pipeline system to the U.S. to take a lot of the crude. It's still happening, despite Keystone not getting the nod yet, and I don't know what will happen with that. So there's still events and developments, but I don't tend to, the view here was to focus on the next few years. You get into the long term, you get into a lot of different issues, but it's a great point you bring up.
Well, Derek, maybe let's pick up on that a little bit. In terms of Energy East and the reversal of Line 9, let's assume that that's going to happen. I know, economists like to make assumptions, but if that does happen, so I'll make the assumption for you. If that does happen, will that be a way in which Alberta's petro and gas wealth can be more distributed across the country? Would that help in terms of spreading some of the
diversifying their markets, and that's the real intention. I think what's driving that is the fact that there's still been a lot of production, but that production's been trapped, whether it's gas, oil, and it's meant that Alberta energy in general, natural gas and oil, sold at a discount relative to prices in other markets like the United States and globally. And I think they just know that with the U.S. really ramping up their production of oil and gas, they need to look at diversifying markets. European Free Trade Agreement, is going to hopefully increase activity between Canada and Europe, so bring some of the production to the Eastern market as part of a wave, hopefully for more movement between Canada and Europe. And so, I think this is a good thing. I think we need to see more diversification, but you've hit the nail on the head. That's a key element.
So it will unlock some more of that.
It will. And the reason why we expect Alberta not to go to the way of the dodo bird, it's still got a tremendous potential despite some near-term slowdown in the growth. Yeah.
Okay. So one final question I have here from the audience. Do you not see the devaluation of our dollar putting pressure on the Bank of Canada to raise interest rates?
Great question. I do not, because what they don't want, where they would raise rates, and we've seen it in some emerging markets, if the dollar really comes under massive downward pressure, they need to do something, or you could have a currency crisis. What we've seen of late is what I call an orderly decline in the Canadian dollar. It's happened now over a year and a half, and we've lost about 10% of value on the currency, and I view it as being orderly. In fact, Polaz, and we're getting pronunciation of his name, I thought it was Polaz, but it's Polaz. The governor of the Bank of Canada is very much, he won't come out and say we want a dollar trading at this level, but I think he's been happy to see the decline, and he views it as orderly. So I think his view would be like ours at TD, that this is good for the economy on a net basis, even though it's bad for certain areas of it. Yeah.
Okay, great. I'd like to ask Mike York, one of our event sponsors and representing the Carpenters District Council of Ontario, to thank Derek.
All right, Derek, thank you very much for providing us with an overview of the Canadian and Ontario outlook for the year ahead. As you will be aware, and the people in this room, the role of the OCS is to provide detailed information about the construction industry and its context. And, that allows us to make commitments and to live up to those commitments to the people of Ontario, to the investors that provide employment for our membership. And your contributions today really assist us in that. I think it's an excellent overview, and thank you very much on behalf of the OCS and the unionized ICI construction industry. Thank you very much.
Nice. Appreciate it.
All right. Have a little detail. All right.